start the recording. So thank you everybody for joining. This is Transformational Tuesday, actually on a Thursday because of technical difficulties on Tuesday. So I appreciate everybody coming here today. It is May the 14th, just to make sure for the recording that we get this. These are always recorded and you can find them on our YouTube channel. So I am going to start sharing. And then hopefully everybody can still see. I can't see you guys. That's what happens when I sometimes share, I lose everybody. So hopefully you can see. My new computer setup is changing all my windows around. So anyways, today we're going to be talking about why do we love the amazing tax benefits of commercial real, oh, it says real estate, real, should say real estate. So I am not your accountant. Super important for this one here to know I am not your accountant for sure. I am not giving tax advice. I'm not giving financial advice. I just want to make sure that you understand that what you're basically learning here is the best and most efficient ways that make commercial real estate investing, and make sure you always do your own due diligence. So again, my name is Trevor. Coaching, mentoring, and a strong team has changed my life. I first started learning about real estate. I always thought everybody had to be a millionaire to invest in real estate. Then I realized that you did not. And so I set out on a mission to make sure that I helped people learn about real estate, be able to do different things. And I was super important about sharing this information. So I started out as a passive investor, and then I switched over to an active investor. I have put my contact into the chat here. So if you get a chance, please feel free to reach out to me. I'm going to move this so it's not showing in the screen. Sorry, I got a little bit of technology issues here. So I started passive investing in 20 syndications, and actually I was hoping by tonight to be able to change this to a 19, but the Gearing Place in Houston won't close till tomorrow. And so that will be 19 syndications that I have done in the period of time that we've been doing syndications. So super excited about being able to close another one. Obviously, massive dreams require massive action. Super important that you take a lot of action and that everything that you're doing is dedicated to learning and advancing yourself and making sure that you are doing everything you can to become successful in this space. So again, tonight we'll talk as always about how syndications, how they work. We will understand returns. We're going to talk about the main tax advantages. Then we're going to spend a little bit of time talking about bonus depreciation and cost segregation. I also thought it was really important to talk about retirement account investing during this call, just to make sure that we did it. And then as always, we have time for discussion at the end. And the most powerful skills in life is the ability to keep showing up even when the initial excitement of the goal has failed. Take massive action. So again, syndications are a way for people to pool their money and to invest in commercial real estate. So what you need to understand is that for passive investors, the syndications are totally passive. So how does it work? So sponsors, general partners, if you remember before I mentioned, I'm 18, soon to be 19. It's a group of experienced real estate professionals who organize the syndication, secure the funding, and implement the business plan. Something else really important to remember here too is the experience, right? So I've been involved in several different asset classes. So for example, on our assisted living asset class, we have people who are experts in assisted living. On our RV parks, we have people who are expert in that. On our multifamily, we have people who are experts in that. So you always have to make sure that this GP team has all of the experts and they are experienced real estate professionals. So again, then there's limited partners, LPs. We've always heard about people talking about using other people's money. This is other people's money to me. So I'm going to basically tell you a scenario here where we're going to go out and we're going to buy a $10 million property. And the sponsors, general partners, they're going to find the property. They're going to do all the due diligence. They're going to negotiate everything. They're going to secure the funding, and they're responsible for implementing the business plan. But then what we need is we'll need some more money, right? Because when we get a $10 million property, they'll probably loan us about $7 million, and we'll need to raise another 3 million. We'll actually need to raise a bit more than 3, but I want to make sure I keep it simple for these circumstances. And so what will happen is we'll raise $3 million from these passive investors. But here's the real magic. On this $10 million property, the folks that put in $3 million on a normal deal that we do, some deals have different splits, you will actually own 70% of the asset. And again, it's limited liability, so it's protected your personal assets beyond the investment. So next month, we're going to talk a little bit about the difference between single family and multifamily. So one of the things, if you're a single family landlord, you're 100% responsible for everything. If your tenant moves out, who's still paying the mortgage? You are. If tenant damages the place, who's fixing it? You are. If the toilets clog up in the middle of the night, who are they calling? You. Now, you may have a property manager, but they often eat a lot of the proportion of your assets. So again, I want to make sure I'm clear. You can lose your investment, but you won't lose any more and you have no other liabilities. You can also target your investments on specific projects. So as again, I mentioned, you will want to put all of your investments in one asset class, in one market, in one property type. I never suggest people, especially when you start investing a lot like I have, I want to make sure that you are spreading your money out so that you can get the best value for your money. And so you can do those. And then again, the returns are tied directly to the success of the project. So again, how does it work? We're going to just break it down to simple terms. We make $1. And if we have a preferred payment until the investors have made 7 cents on their dollar, we won't make any money. And then when we get $1, 70 cents of that dollar goes to the passive investors and 30 cents of that dollar goes to the general partners. So again, there are two ways that we do deals. We always start our deals as a 506B. A 506B can take accredited and non-accredited investors. Just to let you know, an accredited investor, you'll see it near the middle bottom of the slide, has an assets of more than $1 million, excluding your home, or an income of 200,000 single or 300,000 married. So again, when it's not accredited investors, what will happen is you can invest while it's a 506B. We must have a pre-existing relationship. So I have to know you. I think I know everybody on this call, but I couldn't even talk about a 506B deal on this call because it goes out onto the internet. Everybody could see it. So I can't talk about it until it switches to a 506C. Also, there's only 35 spots for non-accredited investors. So we allow our massive capital community first chance to get into the deal. And as mentioned before, no general solicitation. Easy way to remember this, 506B is the buddy system. You're all my buddies, therefore you can invest while you're not accredited while the deal is a 506B. And again, an accredited investor can still invest up here. And in fact, it's much easier if they do because they can just self-select their accredited. They don't have to verify it. But once we switch it to a 506C, I can tell everybody. I can talk about it on this call. I can talk about it all anywhere. I can post on my Facebook. I can post on my LinkedIn. I can post it anywhere. And it's okay to be able to do that. But it's restricted that only accredited investors can invest. So again, there are no differences between a 506B or a 506C, only who can invest. Oh, sorry, this person can't get into the call here. Sorry about that. Give me 1 second. Always something on technology that challenges me. Let's see if this gets them in. So again, if you are not an accredited investor, all you need to do is tell me, hey, Trevor, listen, I want to make sure that I don't miss out on the deal. So many times people will say, well, I want to invest. And then nothing happens. And then all of a sudden we switch a deal to a 506C and they go, oh, I'm ready to invest. And I'm sorry, it's hard. It's a hard line in the sand. Once it switches to a 506C, you cannot invest. It's impossible to be able to do it. So again, the great Warren Buffett, if you don't find a way to make money in your sleep, you will work until you die. And passive investing puts your money to work instead of trading time for money. Show this slide every month when we do it. This is where it's really powerful. So if you remember before, I mentioned that you're going to be able to get the you're going to collect 70% of the profits on a deal that happens. But this is the power of compounding your money and leaving it invested. This is how 90% of all millionaires became millionaires in America because of this. So if you invest $100,000 and we can double it in 5 years, and I've taken taxes out of the scenario for this. So you want to make sure that you understand that you will have to pay some tax. So we're going to talk a little bit about that. But if you invest $100,000 and it doubles to $200,000, you're going to invest the 100 you made, and the 100 you started with, 200 turns to 4. The 100 you started with, the 300, 400 turns to 8. The 100 you started with, the 700 you made, 8 to 1.6, 1.6 to 3.2. So you can kind of see the scenario. Now, I am not telling you that you are not going to be paying any taxes or anything, and you will always double your money. I'm telling you that this is the power of passive investing and compounding your money, leaving your money in the game to grow, right? I know a lot of people say, when you talk to people that do commercial or any real estate investing, not even just commercial, what's the one thing? And everybody always says, I wish I would have started earlier. And why do they wish they started earlier? Because it takes a long time to be able to become a multimillionaire through passive investing in commercial real estate. But you want to make sure that you do keep your money invested. Now, a lot of people say to me, well, Trevor, I want to invest, but I need to live off the income. And I understand that. I just want to make sure you understand. Invest 100, earn 100, live on 100, invest the original 100, the end of 25 years, how much do you have left? 200. That's it. So would you rather have 200 or $3.2 million? So at some point in here, yes, you could start taking some money off the table and start doing things, because this is going to grow. And this is only one investment multiplied. If you could make one investment every year, and I know it's hard to say 100,000, that sounds quite, I just keep that for the simple math. But if you could invest 25 or $50,000 and keep this machine going, this can grow into be tens of millions of dollars. So again, all of the deals that we offer to you are done through Massive Masters, and we're all together associated. So a lot of folks know Phil and Shanoa and Sanjay were my original mentors. Here's Olivia, part of the program, and the Massive Capital team. And what we've done is we have a mastermind where we train people how to be able to do this, how to be able to get into different investments, how to have all of the experienced people. So we help out on all the experience. And we have some mentors that are all part of the program that are experts in different fields. And then we offer you these opportunities through Massive Capital to invest in. So again, we're going to talk a little bit, just reminding you of what returns mean. So again, internal rate of return is one of my favorite returns because it really talks about the time value of money. IRR is unique because it factors in the timing and magnitude of all cash flows. A dollar received sooner is worth more than a dollar received later. And it's not really worth more, it makes the IRR higher. Equity multiple is also a certain, very important number. So again, if you remember my example, I've talked about doubling your money. That's the equity multiple, right? You put $100,000 in and we double your money. And again, I've used the example of 5 years. And the reason I use the example of 5 years is that's a typical timeline for the types of investments that we're doing. But again, it's not always the same timeline. And even when we say 5 years, we may be able to get out in 3 or 4, or we may have to stay till 5 or 6 or 7 because things aren't right to sell. So how it affects it. So again, a typical deal, if we can double your money in 5 years, that's about an 18% IRR. If I could double it in 3 years, that's about a 25% IRR. If it took me 7 years to double your money, that's about a 15% IRR. So again, want to make sure you're understanding. We're always talking here about doubling your money. And again, some deals are 1.5 multiples, some are 2.5. They're all different. You just need to be able to understand, what am I getting? When am I getting it? Because that's super important to understand. And how am I growing my wealth? How am I creating this thing to where I can become a millionaire from passive investing? Now, cash on cash, that is basically the cash flow. So we have some deals with no cash flow. We have some deals with probably about 10% cash flow. And we have some deals where the cash flow builds during the period. Again, the quicker you get cash flow, you will be able to start increasing that IRR, right? Because a dollar received sooner is worth more than a dollar received later. So it's super important for you to be able to understand the flow, but cash flow. So on a typical multifamily, we'll usually return 20 to 40, maybe even 50% of your earnings, of your profit during the 5 year period, but the majority of the money is made at sale. On our new retail development deals, there's no cash flow because we're buying property, we're getting it entitled, we're building something, we're leasing it, and then we're selling it. So again, you just need to make sure you understand it. Now, we talked a little bit about preferred return, but it's super important, and I've even started clarifying this a little bit more. So typically on our deals, we do what's called a 7% preferred return. And it's a priority profit share paid to investors, LPs, before I can't talk, the sponsors, GPs, own their performance fees. So performance fees is the 30%, right? 70-30 split. And again, that can vary depending on the deal. Some of our deals, it's as high as 50-50 split. And I've had some deals that are 80-20, different things to do. But what I want to make sure I'm clear on, because I had some folks recently get very upset with me because they didn't understand. They said, well, you told me I'm getting a 7% preferred repayment. I haven't got any money. No, we didn't say you're going to get 7%. We said until you get 7%, we don't get paid. So we put our investors first. So you need to understand that. Now, our goal is to pay it. Why do we want to pay it? Because we want to get paid, right? Super important. We're not doing this for free. We're doing this. That's how I earn my money. I earn my money on the profits of the general partners. I want to be able to reach it to where I've paid off the preferred return, and therefore we go to the split. And then ARR is just an average rate of return. It kind of just looks at the whole project holistically. And so again, if we double their money in 5 years, you could basically say that's a 20% IRR. And again, it really just depends, but that one I want to make sure I put in there. So again, we're going to talk about tax benefits and investing in commercial real estate. I have kept this very high level. And again, I am not an accountant. I do believe what I'm sharing with you to be true and genuine, but I am not an accountant, and I've kept this very high level. I would suggest if you want to get into it even deeper, then you would want to spend some time talking with your accountant. So one of the things investing in commercial real estate syndications can create several tax advantages, especially because the deal is usually structured as a pass-through entity. So it's very important to understand our syndications are a pass-through entity. Very important to understand this. So income deductions, losses flow to the investors on their K1 rather than being taxed at the entity level. So again, it's basically we've started a business, we own a business, our investors own the largest percentage of that particular business, and all of the benefits proportionately pass through. So again, it depends how much you've invested, depends what you've done, where you are in the total percentage of it. But again, all of it passes through. And some of the bigger common benefits include depreciation expenses, possible long-term capital gains treatment on the sale, and sometimes passive loss of offsets. So again, there's a lot there to be able to do it. So some of the main tax benefits, obviously depreciation. This is the building portion of the property that can be depreciated, which creates a non-cash deduction that may reduce taxable income even when the asset produces cash flow. So again, you're buying this $10 million building, let's say. And you have to remember when we're buying this $10 million building, there are things that we can't depreciate, or there are things that are at different levels of depreciation. So let's just kind of use a rough number, right? So we bought a $10 million property. and we can depreciate 70% of that. We can't depreciate the whole $10 million. And when we get our cost segregation studies done, they're like 30, 40 pages long, and they isolate everything out. So again, normal depreciation is over 27 and a half years. But then what they've done is they've allowed us to do cost segregation and bonus depreciation. Basically, it's depreciation on steroids is the best way to describe it. It allows us to really reduce. So instead of 27 and a half years, it reduces down to about 5 years. And there's a bonus that a large portion of this depreciation comes in year one. So again, I'm going to give you a rough example. I can see David's on the call with us right now. We just closed Woodland Ridge at the end of last year in North Carolina. If you were to put $100,000 in Woodland Ridge, you got about a 65%, didn't come out quite as high as we were hoping, 65% passive loss on year one. Now, what does passive loss mean, right? Passive loss doesn't mean David wrote you a check for $65,000, right? He didn't. But what it says is, okay, we could depreciate it. So we're going to give you this passive loss, and passive losses can go against passive income for a W-2, sorry, real estate income. If you have a W-2, you can only do passive losses, also passive real estate income. If you're a full-time professional like David and myself are, we can take the whole value of that bonus depreciation. So it can be super powerful. So think about it again. I have a $60,000 tax bill that I have to pay IRS, and I invest in David's deal, and I put $100,000 in it, and he gives me a passive loss of $60,000. I no longer have to pay that $60,000 tax bill. And so what can I do? I can, instead of paying the tax bill, I can invest $60,000 in his next deal and start the wheel of bonus depreciation all over again. It's super powerful. We do have a little bit about recapture. I don't do a lot on it because it's quite complicated, and I didn't want to make it too complicated for here. Just let you know that it is a super powerful way, right? It's not how much you earn, it's how much you keep. So again, you can do a lot of other things, obviously expense deductions, right? Just like any business. All of the operating costs, repairs, management fees, property taxes, mortgage, interest are all deductible at the property level, and they pass through to us as investors. So again, you have to remember, we've formed a pass-through entity. That's the most important thing. So everything we spend, only what's being kept over is being passed on to the investors, and you're only paying taxes on what is passed through. So again, losses from a syndication are usually passive, so they may offset other passive income, and they generally do not offset your wages or self-employment income. Now, I don't want to make it too complicated. There are some real estate classes like Airbnbs where there is some pass-through that will do for your wages. There are other taxes such as opportunity zones and or oil and gas. I've never invested in any of those, so I don't really talk about them, but I just want to make sure that it's clear, because a lot of other people are going to tell you, oh, you're going to get all these passive losses. It's going to be fantastic. You'll never pay taxes. And it's not true. I want to make sure you get the right information and you know what you can do. And again, super powerful to do it. And then again, this is super powerful. Long-term capital gains on exit. If the property is held for more than 1 year, the gains are generally taxed as long-term capital gains rather than ordinary income. So again, if you're paying out ordinary income, you're probably paying around 35+% tax on your ordinary income. And depending on your tax bracket, and again, I'm not your accountant, but it will probably be no more than 20% taxed on long-term income. So again, it's super powerful for you to be able to do. Very difficult to do out of syndications, but I left it here because if you do have a single asset structure, it may allow a 1031. I just wanted to add it here because there are folks that are in our group that aren't all doing syndications. So if you're doing a joint venture and everybody agrees on the entry and the exit, you may be able to 1031 out of a deal. So it's a super powerful way to also pass off and not pay the taxes when you're going to get it. It's a great way to be able to move your money around, but it does not normally available in the syndication structure. So I wanted to make sure. What are some of the things that you want to watch for, right? Because I'm telling you all this good news. So tax benefits are often strongest in the early years when depreciation and bonus depreciation are the highest, but that can result in paper losses without matching cash losses. Also, tax treatment depends on the syndication structure, your own tax structure, whether the losses are passive and can be used against other income. So that's kind of like my little, I'm not an accountant disclaimer here. Just got to make sure that you really understand it because you want to make sure that you are using it to the best of your ability. So again, if syndication generates cash flow, large depreciation in year one, you might receive a taxable loss to reduce your taxable income, even though the property is sending you distributions. That's one of the reasons these deals are also attractive to high income investors. So again, think about this. You invested $100,000, you got a $60,000 passive loss, and we paid you $10,000 in cash flow. Well, you won't have to pay tax on the $10,000 you got in cash flow because you've got the passive loss to offset it. So think about it. So you're going to earn, let's say over the 5 years, you earn $50,000 in passive income. You have deferred all of that tax. Now, eventually there is some recapture, but if you take that $10,000 and invest it in a deal, if you take that 10,000 next year, invest it in a deal, and you keep that money growing and moving, you will always be ahead. You want to make sure that you're always ahead. Some of the common risks of syndications, tax benefits that they may delayed or be limited or unusable. Now, this is the really good news. Unusable isn't a bad word here. It's not a use it or lose it. It sits there until you can use it. So if you have a job and you get this $60,000 passive investment from investing with us, and you can only use 10 of it, that's okay. The 50 sits there until you can use it. It sits there until you can use it. It just keeps sitting there rolling forward until you can use it. Super, super powerful, right? So the passive losses cannot offset your W-2. It's very rare they can do it. Or self-employment income may be suspended till you have passive income and sell the investment. So again, I want to make sure that you understand this is not a one size fits all, but everybody benefits. Some people may benefit more, but everybody benefits. Okay. So some of the major risks, right, is no immediate tax relief. Investors often expect a year one write-off, but syndications may not produce meaningful deductions right away. Passive loss limits, there are things such as passive loss limits that are trapped under passive activity rules. And again, these are kind of my disclaimers. The benefit depends on the deal structure, tax outcomes, can be very differently, whether you're using cost segregation, bonus depreciation, or a 1031 strategy. And again, these are all strategies. Tax benefits can be reversed later. So early depreciation can be reduced by taxable income now, but some of those benefits may be recaptured when the property is sold. So again, you need to make sure, and I'll probably do another lesson more, talk more about recapture. And again, it's sponsor specific issues, right? You want to make sure that you understand all of these things will be disclosed in the PPM and our operating agreements when you're going to get it. So again, some of the biggest mistakes is buying it for the tax benefits only. Never, ever, ever make an investment for the tax benefits. That is the tail wagging the dog, right? I always say the passive investing is the meat and potatoes. I'm going to have some meat and potatoes tonight when we've done our call here. But the bonus depreciation and the tax benefits, they're the gravy. And I love gravy on my meat and potatoes, right? So again, don't do passive investing just for the tax benefits. Make sure you're investing in a good deal that is producing good cash flow with good partners, good returns, all those other things I mentioned before, good IRR, good equity multiple, lots of different things. And again, you want to make sure that you do it. So again, it is a big incentive and it's something you want to study and make sure you're balancing out, right? The last thing you want to do is have a taxable event that was unanticipated, right? You want to be able to build up these passive losses as long as you can, but do not invest purely for these. This is just the icing on the cake, better than even meat and potatoes. So I want to talk a little bit about using self-directed retirement funds because about 60% of my investors invest with self-retirement and self directed retirement funds, right? So it's a very powerful way to invest, right? So you can use them to invest in commercial real estate. It's allowed. Retirement account must be an actual investor in the deal to prevent any prohibitive transactions. And there are some taxes like UBIT and UDFI. I'm not going to get into them too heavily right now. I can share a link later where you can go to Directed IRA Company. They have a lot of really good videos on these topics, so I can share their link to their website. So again, how does it work? You can use self-directed IRA, in some cases 401k, to buy syndication interest through an account custodian, not in your personal name. So again, I want to make sure your current employer is not going to allow you to do this. And the reason they're not going to allow you to do this is the system is rigged. They make money on your money. Everybody makes money. The whole Wall Street system is made to make money on your money. And I make money on your money, but after you make money, that's the biggest difference. You can have all of these fees, you can invest in the mutual funds and all these different things, and they're very fee heavy. So if you have changed employers and you have some money, you can move them over to self-directed IRAs. And again, I use directed IRAs where I refer a lot of people, but they're not the only option. There are lots of options. And again, what you need to understand, this is super important to understand, your IRA and 401ks are tax deferred. So again, a lot of other sponsors, you'll go to a lot of calls and they'll tell you it's tax free. It is not tax free. It is tax deferred. If you have $100,000 in your IRA and you grow it to $1 million, when you start pulling the money out, now when you're earning that $900,000, it's tax deferred. You don't owe anything. As soon as you start withdrawing the money, it's taxable. So again, I want to make sure that you understand now, if you're super smart, you're going to pay the taxes now and put it into a Roth account, and it will grow tax-free in a Roth account. So again, something I wish I'd have done. I talk about it. If you can move some money into a Roth. So again, let's think of this scenario. I want to put $100,000 into a deal. I've got an IRA worth $130,000. I'm going to take a $30,000 tax hit today. I'm going to convert that to a Roth. So you say, Trevor, are you nuts? You're going to pay $30,000 to make an investment. Listen to the whole story. And then I double that to 200. Then I double that to 400. Then I double that to 800. Then I double that to 1.6 million. Then I double that to $3.2 million. That $30,000 you spent today earned you $3.1 million tax free in 25 years. That is absolutely, positively mind blowing, insane that somebody will let you do something like that. So again, if you can, do it. And again, I'm not an expert in it, but I can refer you to folks that are really good. They offer a lot of free training. Now, one other thing I want to make sure that you're clear on, all the other stuff, the bonus depreciation we talked about, is not available to your retirement account. So you cannot get the bonus depreciation in a tax deferred or tax free account. So again, you want to make sure that you're understanding that. Now, I also want to make sure that you understand there are times that I always recommend that you would use retirement funds or you would use cash, but none of these statements are exclusive. So I had a situation once when I was first starting, and I wish somebody told me this. I had $100,000 in my retirement fund and I had $100,000 in cash. I invested the $100,000 in cash into a new development deal with no bonus depreciation. I invested the IRA money into a multifamily and was ineligible for the bonus depreciation. If I'd have just done this, I would have been way ahead. Okay, because there's no bonus depreciation. We're buying land. You can't depreciate land. We're building something. There's nothing to bonus depreciate about it. And again, it doesn't mean that's a bad investment or a good investment. Do not let the tail wag the dog. But you want to make sure you're talking to people that are going to help you keep as much money as possible. I wish that that sponsor had said, hold on a minute, Trevor. Now, the difference is I was investing with two different sponsors, so they didn't know what I was doing. So I want to make sure you know what you're doing. So again, does that mean you should never invest in multifamily with a retirement account? Absolutely not. Does that mean you should never invest with cash into a new development deal? Absolutely not. Invest, invest, and invest, invest. Again, look for the right deal, look for the most efficient way to invest in it, and always be thinking about how I can do this the most efficient way. How can I use the rules that the IRS has put in place to pay less taxes? There's I'm drawing a blank on his Ken McElroy, who is Rich Dad Poor Dad's accountant, says if you want to change your tax, you got to change your facts. So again, you want to change your tax, you got to change your facts. You got to know that you can do this. And a lot of people don't know that you can do this. And again, you got to make sure that you follow the rules when you invest with your retirement funds, right? The retirement account, not you, must own the account, not you personally. You cannot give personal guarantees or receive signed benefits. The operating agreement sufficiently documents must allow it. All of it are due. Syndications that use leverage may trigger UDFI. So again, that means that you may have some taxes when you start making some money. And again, don't worry about, just worry about the most effective use, right? So I should say, well, I'm going to get some taxes, so I'm just going to leave my money sit there. That's ludicrous. I'm not going to double my money because I might pay some tax. I mean, it's ludicrous, right? You want to make sure you're doing it, right? Self-directed IRAs are the most common vehicles. You can also have a solo 401k. You can also use self-employment. So again, I could do it. I have my own company. I invest. I do this full time. I'm not currently. Traditional brokerages use IRAs, but they don't really support it, right? So you're not going to Merrill Lynch and all of TD and all those other guys. They're not going to support these. There are a few big ones like Fidelity that does. They're a real pain to deal with. And that's why I always recommend you use somebody that this is all they do. So again, how to do it? You would open your own self-directed 401k. You would fund it by transferring. Here's another big important tip. I told somebody, hey, you can move it into self-directed IRA. You can do this, you can do that. Set up the account. And what I omitted to say was set up the account and put a minimum funding in the account like $100. This guy put in $250,000 and had nowhere to move it to. So it went from an account that was at least earning some money on the stock market. And at the time, stock market was actually doing really good. When you're sitting, your cash is sitting in a self-directed retirement fund, it is not earning any money. I've heard there's a loophole. I'm trying to find out more to where you can invest it in something. So I want to make sure. But again, understand, open the account, move your money over, get it all going. And then when it's time to move your 100,000 into the account or 50 or 25, whatever you're doing, then move it when you're ready to invest it. Then you have the custodian do it. So again, when we do all this paperwork, you'll fill out all the paperwork. We'll help you with the paperwork. Then we send all that paperwork to your custodian. Your custodian sends some things back for you to sign. They're the official signer of the deal on your behalf with your authorization. They fund the deal, and all of your dividends, all of your profits, everything goes back into your retirement account. And again, it all flows back in. So again, biggest risk are accidentally doing some prohibited transactions. It's really hard to do that in a syndication. Very easy to do it when you're doing things like buying single family or doing some other things, or you can't, there's a lot of rules, right? So just make sure if you're going to do anything that you follow the rules, right? So again, this approach tends to fit investors who want passive exposure to larger commercial deals. They already have a retirement capital that they don't need for long-term liquidity, which works best when the sponsor is familiar with the retirement account. So again, make sure that you talk to whoever's doing it, make sure that they understand or at least can direct you to somebody who understands. It's a very powerful way to invest. And also, again, this is just off the cuff advice. If you're not going to retire for a while, you want to go for the equity build, right? That's your most important button. Your equity multiple is kind of your most important button. Again, on time frame, right? So tied with the IRA. If I double your money in 10 years, it's not near as exciting as 5. Very more exciting when it's 3 years. But again, because you're not going to be taking that money out, so you don't worry about the cash flow or some of the other things. I'm on some deals and I made some investments early on at the beginning where I got a 10% cash flow, and it was kind of useless till I built it up to about 10K and I could invest it in something. So again, just think through it. And again, make sure you understand UDIF if you are going to be able to do it. So again, I'm not going to do too much run and getting close on time here. So I'll just share a link later on directed IRA. They've got a lot of education. And again, do not forget the power of a Roth, right? A Roth, you can invest in syndications through your self-directed Roth, and you want to make sure that you are doing that the best way to grow your wealth. I'm not going to get through there. So again, make sure that you don't personally guarantee any loans, use the property for personal benefit, mix personal and IRA benefits. Anything you do can jeopardize your IRA's tax status. Use a self-directed custodian. Make sure the syndication allows them. Review the PPM and operating agreement. Ask who prepares and does the K-1s. Keep all transactions strictly inside of the IRA. You want to make sure that you're doing all of those things, right? So investing wisely in commercial real estate syndications can unlock significant tax advantages, but you must understand the details is the key to maximizing your benefits. So again, I hope this was helpful. I hope you gave you some suggestions. I haven't seen any questions pop up. Just want to make sure because it's been a little while. So we did close on our senior assisted living. We're actually doing all the renovations, getting the permits. This is a 32 bed. I hope we have another one of these deals soon. Super excited. We'll be opening soon and I'll be able to present some stuff on what we're doing. We closed on our property in San Antonio. It's been almost 6 weeks now to where we have our property is 48 units in San Antonio. So again, you can see this one had a 9% cash on cash, the 2x multiplier, 18 IRR. This was a 5-year deal. Hopefully we'll be doing a property tour the next couple of months. We want to get the property fixed up a bit and get going. And then this is the one we're going to close on. I was hoping we'd close tonight, but we're going to close tomorrow. So we've actually funded Tuesday, finished all the legal work, and all of the documents were signed by the seller. The money transfers in the morning. We get the keys in the afternoon. And Saturday, this 24-unit stabilized asset is to be able to going to be done. It's fully funded. It was a 9% cash on cash, 2x multiplier, 18% IRR. And then this was a deal. We're going to do a little webinar on it a bit later. We had a 72 unit in Houston, and we actually withdrew from the offer. So I'm going to do a presentation. Might do a special webinar on that one where we just talk about why did we do it. And we did it because we started to find some things that was at risk for everybody, and mostly our investors. The general partnership team that put this deal together actually lost $72,000 of their hard-earned money. But again, better to walk away. Sometimes the best deals that you do are the ones that you don't do. This one still may come back. We're still working on it, but we need a price adjustment to be able to fix it. We just found out, we had some things in our due diligence, and then as we got deeper into the due diligence, we found a lot of things. And then this also required a loan refinancing, and some of the things that are going on in the marketplace made that riskier than we wanted to do. So again, you're one decision away from a life. Decide to take massive action. I'm going to post my contact info in here one more time. And I'm going to stop sharing. And there was one question. that I didn't get here to. So the best deals to use self-directed IRAs. And again, any deal that's a good deal is fine to use your self-directed IRA. But if you have a difference, right? If you, like I said, if I have cash and I have IRA money, I would always say use your IRA money on a deal that doesn't have bonus depreciation. Doesn't mean that's a better deal or a worse deal. It's just if you're looking for the most tax efficient way and you have both options. But if you only have IRA money, and you can invest it in a new development deal. You can invest it in multifamily. There is no difference because the only difference is cash, you're going to get the bonus depreciation with multifamily. Cash, you're going to get the bonus depreciation with our senior citizens because we bought an existing building. Even with our RV park, there was some, we could write off a lot of the assets. You can't write off the land, but you can write off all of the assets. So there's lots of different ways you can do it. Let me get directed IRAs. And again, I don't get a kickback from directed IRA. But if you look at them and you want, I can connect you with them. I just do it because they're super helpful. They really help me out. I like people that help me out. Let me just find it here. Sorry, scrolling along. Any other questions? Appreciate everybody showing up. So if you are interested, just let me know. I can do an introductory email, put you together just to make sure you get good advice. Any other questions? All right. Well, you guys have a good week. Hopefully soon we'll have some property tours that will get active again. We had a little break on them. So make sure you stay connected with me. Make sure that you're connected with me. I'm just going to put one more thing in here. Make sure that you connect with me on LinkedIn and Facebook, because if we are doing some of those things, I do share them there. So I'm going to put this in here. This gives you all of my contacts, including my social media and my YouTube channel. Awesome. Thanks, everybody. So nice to see you all. Have a great evening. Thank you. Bye-bye.